The principles and benefits of long-term investing are things that are going to be helpful to people throughout ages. But this message is especially valuable in the year 2021 with the craziness going on in the markets, and it needs to be heard. So for every text message that you receive from a friend asking which hot stock they need to get into, send them this video instead. Long-term investing allows you to take advantage of compounding interest, and compounding interest is one of the strongest forces in the universe. But its very nature is the exact opposite of what our society here in the United States today loves, which is instant gratification. Compounding builds slowly over time, and it requires patience. One idea that kind of articulates this fact is the $10,000 rule, which says that when you're building up wealth and saving into an investment account, you really won't notice the benefits of the growth of those investments until you're somewhere around the $10,000 mark. Before you have $10,000 in an investment account, really your contributions into that account, whether it's through your biweekly payroll deductions or a monthly contribution to a Roth IRA, those contributions will be the primary growth of that account. But sometime after the 5-figure mark, say the market goes up 10% in a given year, you'll certainly notice an extra $1,000 gain in that account that you didn't have to put the money in for. So really only after that point will you start to notice the power of compounding interest. So this is why it requires patience and a good head on your shoulders to continue to save into these types of investment accounts before you actually have that 10 grand, which can take 2, 3, 4, 5 years in some cases. You just have to do it knowing that in the future you will receive a benefit without actually getting any instant gratification. And over the long term, the results of those investments are far more predictable than a stock that is moving up really quickly but will inevitably move down really quickly again in the future. We can never know exactly what a single stock or fund or even an entire market index is going to do in the short term, but we do know what will happen in the long term. There has never been a 10-year period in the United States market history in which the market was lower than it was 10 years previously when you may have started investing, and especially if you're adding in periodically, like I said, through monthly contributions or biweekly payroll deductions, any period of time in a 10-year stretch where the market is lower, you're actually buying more shares at that time if you're using the same amount of dollars since the shares are cheaper. So you will have ended up with a net positive return even if the market broke even in a 10-year period. And realistically, we typically come back from recessions in the US within 3 years, so you're not too concerned about losses over the pertinent time frame, which is again a long period of time. And those points perfectly describe another major advantage of long-term investing, which is that it can be automated. You don't have to think about it. So you are building wealth passively, literally becoming rich if you're using a high enough monthly or biweekly contribution, and you don't even notice that it is happening. You don't have to do anything to keep it from happening. You just set up the distribution one time when you're 25 years old and leave it there for 30 years. You can use almost any indexed fund, mutual fund, balanced portfolio. It doesn't matter all that much. As long as you do it consistently and you don't stop and you don't sell out, you are really setting yourself up for success. And if you do all this right, it will also take the emotion out of investing. If you're thinking about when you might want to start buying certain positions or when you might want to sell out of the market completely because you think the market's overvalued, then your emotions are guaranteed to influence some of that decision making. We're all human beings. Our brains are not calculators. Our brains are influenced by hormones and emotions that we experience, and our thought processes are as well. Nobody's perfect. No one can totally filter emotions out of their decision making. So if you're actively making decisions on how your money's getting invested, it's impossible not to make those decisions at least a little bit emotionally, and that is just not a good thing to be doing. Actually, taking the emotions out of investing might be the single most important factor in investing and maybe the single biggest benefit to a long-term investing strategy. One study that was released by Morningstar, but I'm not exactly sure who gathered the data, showed that in 2018, 10 years after the great financial recession of 2008-2009, there were still like 20% of retail investors' investment accounts, and this looked at 401ks, IRAs, and non-qualified accounts. 20% of them were still all in cash. They were still too scared to buy into the markets from a recession that happened 10 years prior. All that cash did not see any growth in the huge run-up that the market had during that 10-year period. And that's because their investing decisions were influenced by emotions. Every year, the research organization Dalbar comes out with a quantitative analysis of investor behavior, and this study almost always shows the same exact thing. In the year 2018, the S&P 500 ended the year down about 4.3%. The average investor out of maybe 6,000 or 7,000 investors that they looked at that year ended ended the year down 9.4%. During the 10-year period ending in 2016, the S&P 500 averaged a 7.23% average annual return. The average investor, out of thousands of investors that they looked at who are managing their own investments, averaged a 4.2% return. I'm citing the average annual return numbers here, which are only about 3% different, which might not seem that bad, but 3% difference compounded over 40 years is a massive difference. It's probably literally going to be the difference between having 300 grand and 1.2 million. It is just an astronomical difference, and this is very, very bad news for public investors. This is bad news for people making their own investing decisions, but these are the real results that Dalbar publishes year in and year out. You need to hear that never touching your investment account will net you so much more money than trading it often. Sometimes the market can seem like a sure thing. You can be positive that it's going to go up at a certain point, or positive that the market's overvalued and a recession has to come, so you should sell out. It's just been proven thousands of times over hundreds of years that you cannot know what the markets are going to do. Not touching your investments is the better strategy, period. It's often said that the smartest people out there know what they don't know or what they can't know. And we as investors need to know what we can't know. We cannot know what the market's going to do over a short period of time. I have all the academic qualifications in the world that an investor could want, and I work with hundreds and hundreds of clients talking about their investment portfolios every day. And I'll tell you right now, I have no idea what the stock market's going to do tomorrow or next month or in a 6-month, 1-year period. So I certainly don't make investing decisions based on this because I know the facts. I know that if I want to build wealth over time, I need to stick with a long-term strategy and not change my investments based on short-term feelings or emotions or things I think are right. There's just so much less risk in a long-term strategy too. When you're looking at these people making short-term day trades or a period of time swing trades, there are certainly cases where people make a lot of money in a short period of time. I'll tell you, very few of those cases will those people tell you about when they lost all their money. And if they continue using short-term trading strategies, there's over a 90% chance that they'll give all that money right back to the markets. There are extremely few people successful in short-term trading, and the ones that are have honed in on specific strategies, and they stick to 1, 2, or 3 strategies over a very long career, and that's the only way to make short-term trading work. Looking at what is running in the news and making investment decisions off what you hear people talking about is never a systematic way to make trading decisions, and it will almost always, more than 99% of the time, result in you giving back any profits you had. It's just so much more volatile. The year 2020 is a perfect example to the power of long-term investing. If you were buying a total market fund and your investment portfolio was down 32% and you were freaking out, not letting those emotions affect your investment decisions resulted in like a 25% gain by the end of the year. The markets came all the way back. It was a crazy run that the market made throughout the course of the year. Almost no one predicted it, especially in the lows of March. I was deeply involved in all the financial media at the time, and I saw 1 or 2 people say, you know, this thing could make a good run in 98, or saying, no, this is going to get way worse. I had clients in my office literally crying, asking to pull all their money out because they knew that the COVID pandemic was going to crash the markets worse than we had ever seen in the past. All those people were wrong. Markets are resilient. They always come back. So my point is, when you're implementing long-term investing, even when the thing is down, that's actually when you want to start buying more. Do not make any changes to your investment allocation. Just put more money in it. I ended the year 2020 up 44.5% or so in my 401k, and that's because when the markets were down, I did not change my investment strategy and I increased my contributions to that account. I also had a good chunk in small caps, and small caps ran up in the fourth quarter, so that's a little bit of a difference. But no matter what strategy we're using, if you did what I did and just contributed more when the market was low and traded less when the market is up, you would have ended up with an amazing year, a spectacular year. You only need like 10 years like that in your career to easily make over $1 million in investment accounts and really build wealth. We need to be doing the opposite of what we as human beings typically do, which is trading more when the market is high. When the market's really high, you should trade less. You should sit back on your laurels, really don't pay attention to it. It's good that your account value's up, but you certainly don't want to get more aggressive in periods when valuations are historically stretched compared to what they've been in the past, and you don't want to do more trading just because more names are running at the time, more stocks are running at the time. Those stocks are not going to last forever, especially with sketchy business models. So be like Warren Buffett. Buy when the market is down and hold good investments for long periods of time. He says he has a lot of investments he'll never sell in his lifetime. That's a little too long for me. I feel like I want to sell them when I'm like 60 and cash out or something. But there's a reason he's widely considered the greatest investor of all time. I'm sure Warren Buffett is not influenced whatsoever by the financial media or the regular media nowadays, because so many stocks are hot and running in the news that they make the regular news. He's not buying those names. He's buying good, solid investments that he knows are going to be around 50 years from now. They're going to pay interest, pay dividends, and grow over time. If you're watching this video and you're serious about building significant wealth, you might be able to pick up on it just kind of by my tone throughout this thing, but I'm really pleading with the general population to employ long-term investing strategies. Do not get caught up in the craze of this short-term market. If you do this well, it is not hard. It's automated. You don't touch it. You don't see it. You don't worry about it in your budget. You don't even have to log into your computer to do anything. It takes the emotions out of it, and you are really going to set yourself apart from the pack. You're going to have a much better life, retirement, more money later on than everyone who's all up in the craze of short-term trading like we're seeing in 2021. So please make smart decisions with all of this, everyone. If you've gotten to this point into the video, it means you watched the whole thing. I really appreciate that. YouTube loves the long watch times in terms of total minutes watched and percentage of the video. If you could also like this video and subscribe, both of those things help me out too, and I appreciate them. As always, thanks for watching.